Hi, and welcome to the weekly market update for the week of May 3rd, 2021 with Morton Brown Family Wealth. I'm Dennis Morton here with Katie Brown. How are you doing, Katie?
Great. Hello, everybody.
All right, so I think today marks a little bit of a pivot or a line in the sand as far as what we talk about during some of these conversations, because all of the focus so far this year, a lot of the focus from an investing perspective has been on speculation and all these places where the markets are really getting frothy. But Katie, we're going to talk a little bit today about how financial planning is really coming front and center. And that sound you hear in the background, all the Dogecoin and GameStop and everything else that's been happening, that's the sound of the accountants and planners and estate attorneys sharpening their pencils. Is that right?
That is right. It's a fascinating year for financial planners and for investors.
So let's start with a little bit of just the noise that's out there. So, just this morning, we were looking at Dogecoin, which has just been ramping up like crazy. I think the stat that came out today that with its current valuation, it's worth more than over 400 members of the S&P 500, which is just insane to think about. Katie, you found an article on how to talk to your kids about how investing is not a game. What were some of the lessons you pulled out of that?
Yeah, I think that we are at a point where investing in a lot of respects has become kind of like a game. And it's driven by so many different areas. It's the platforms that people are investing on, the confetti coming down and just the excitement around placing trades. It's the social media hype around them. It's almost, equated to almost like an online betting, but with real investments kind of backing behind it. And so the article was a good cautionary article. There are people who have hobbies, and investing, I think, can be a hobby as long as it's at the right level and with the understanding of it's a lot of speculation. It's not necessarily what you want in place to reach those long-term goals.
Right.
And so just some of those reminders, I know we kind of hashed out a couple of them. What were some things that you thought were good in there?
Well, they talk about the difference between speculating and investing, and also the idea returns don't happen quickly.
Yes.
That's something. If we're talking about how to teach something, I had a conversation with my kids recently about how, what are you getting better at? If you're spending time intentionally, getting better at investing is very different from getting better at trading on Robinhood, because you may not be actually learning a translatable skill to be a successful investor, because that's not how this works in the long term. But the last point that they brought up, I think, was the most important one, which is keep your emotions out of it. You have to keep avoiding the crowd mentality and that fear of missing out. I think I count myself as pretty lucky that at least when it comes to investing, emotions don't often enter the equation. How do you feel about the emotional side of investing?
Yeah, I think that's exactly it. And so much of that, I think, goes back to making sure, once again, that you're invested at the right level, because emotions will run higher when there's more at stake than they will if you really kind of assign it that game or speculation level that you're comfortable knowing that this could go away. It might double, it might triple, and that happens, and that's awesome, but it very likely may not as well. A couple of the other pointers I thought that were really good in that article too is the reminder of option strategies. The option strategies are so tricky and can be really involved, and they are not beginner strategies. I think back to when I had my securities licenses and got my Series 7. It was a lot of studying and understanding to recognize the difference between a put and a call and a straddle and how they work and where those intersections are of really making money or losing money. And it's
Right.
not a simple thing to just kind of put in place. And I think, unfortunately, some of these platforms are created with this, simplicity mindset of, oh, you can do this and you can, really increase your returns. But there's a lot of risk to them as well.
Yeah. So that's a lot of what we think can be the distraction if we're trying to educate the people around us, like make sure the distraction doesn't take over. So for certified financial planners, you and I are both CFPs, we are really thinking about something very different right now. And it's something that could be, these changes don't come along very often. The changes that were proposed or being proposed for tax laws, the way different assets are treated, what happens upon people's passing, this could be a sea change, and a lot more analysis has been done in the last week. Let's talk a little bit about, why don't we start on capital gains taxes. You found an article talking about how those capital gains taxes might apply and how people should be thinking about their exposure to them. What did you find in that Wall Street Journal article?
Yeah, I was going to mention that the Wall Street Journal has been doing a good job, I think, covering some of the different angles of the tax law changes, potential tax law changes. And one thing they pointed out, and we want to make sure that we're clear about this too, that these, as the laws are proposed, they do not apply to every investor. In fact, they only apply to a very small percentage of investors. The capital gains tax law changes are really targeting when you have capital gains in excess of $1 million. That's where that large increase comes into play. And so looking back at tax returns from 2019, that only applied to 2.7% of tax filers, but that 2.7% accounted for 62% of the capital gains out there. I think that this change in law, hopefully will only apply to a small margin of taxpayers, but could have the potential to make a significant impact for tax revenue.
Right. I think some of the planning that we do for business owners, the thing to be aware of is it's very few people who have capital gains in excess of $1 million every year. But for many business owners, there's 1 year when you have it. It's that time that you sell your business and have a big spike up in capital gains exposure. Does that get you over $1 million? That's something to consider. But I think that's where we're going to be thinking through, are there assets that you might be planning on selling some point in the future that would spike you up for a short period of time into that 2.7% or whatever it might be of exposure to a higher cap gains tax? We also found an article on the step up in basis. So Cody and I talked about this last week, how step up in basis is when historically for the last 100 years or so, if you had an unrealized gain and you passed away, your heirs would inherit it at with the basis as of your date of death. Now that's being changed. Katie, talk us through some of the nuance to this and how this affects estate planning.
Yeah, so that step up in basis, they are looking at putting a $1 million exemption on that amount. So an individual could transfer something, get that step up in basis for $1 million, but if they have unrealized gains greater than $1 million, then that amount will be subject as ordinary income taxes.
Mm-hmm.
They are keeping still in the proposal the homeowner's exemption for your primary residence. So that's another $250,000 per person. So for a couple, that's up to $2.5 million of a step up that you could get in the basis when you transfer assets. But just recognizing anything above that could be subject to ordinary income taxes.
Mm-hmm. Mm-hmm.
So that is quite a potential increase for some households. We're kind of used to the high estate exemption right now, and that step up in basis, really a very low estate tax environment up to this point.
I think one of the interesting things, kind of conundrums here, there's family business implications. So if you have a closely held business that you're trying to transfer to the next generation, what does that do? Also, in my first reading of this, I had thought, okay, your heirs can inherit this asset. They inherit the lower basis as if you had gifted it to them in their life. And then when they sell, then it gets stepped up. But no, it's treating almost death as the transaction date. So when you pass, taxes are due. Like it's a triggering event. So it just coming back to capital gains being something you can determine. When you sell, you owe this. Well, your death becomes a triggering event if you're exposed to these types of to the step up basis change. It's also been there for 100 years, which, we talk about those untouchable things. This was kind of something that had been untouchable for a really long time.
Yeah. I guess there's been conversation for the last 50 years or so, should this come to the table? Should it not? But this is the first time it's really been brought to the table. I think the charitable giving implications will be really interesting too. Yeah. We've talked about before the advantages of gifting appreciated stock. Well, now, if you have written in your estate documents, I want to leave, $500,000 to this organization or whatever, you may want to go in specifically to say this asset goes there, this asset goes there, or set up all of those plans in advance and put together those charitable strategies in advance if that is part of your plan anyway. But I think that will be really interesting because it really does apply to that significant appreciation that may be embedded in there.
Yeah, I think it's an opportunity for some of the nonprofits that we know, charitable organizations, to really communicate that well to their donors and people who might have these events coming up. I think the key for all of this, and it's in one of the journal articles, is there are things that you can do and should do to make sure your estate plan is updated, things like medical declarations or HIPAA declarations. There's things that, God forbid, you become incapacitated or pass away, you want to have in place. But don't jump necessarily right now, and don't panic. It's okay to sit tight and be ready to engage with your team, which is a lot of what we're going to be doing. We're going to have more of these conversations, especially in video form. So there are a lot of conversations to be had around estate planning. We think this is really good focused work for certified financial planners and other professionals to be working on right now around the distractions that are happening in the markets. If you have a question, or if you're feeling a little bit panicked about what could change and how it impacts you, please reach out to us, and we look forward to having these conversations as we go along. Until next week, we'll talk to you soon.
Take care.